Hey everyone, welcome back to Corporate Decoder, the place where we dig into financial reports with the finesse of a truffle pig and the smirky charm of a seasoned detective. Today we are dissecting Crestline Lending Solutions LLC's latest quarterly filing, and trust me, there are some interesting moves happening behind the scenes that could impact how they make money. So before we dive deep into the numbers, if you love getting the real story behind corporate filings, hit that subscribe button and ring the bell. We also have a fantastic community over on Discord linked in the description below where we break down these reports even further, so join the conversation. Alright, let us get straight to it. Crestline Lending Solutions LLC is a company that is essentially a lender for other businesses, kind of like a bank, but for companies that are not typically found on the stock market. Think of them as funding the backbone of many industries. Looking at their balance sheet as of the 30th of September 2025 provides a snapshot of their financial health. Their total assets have grown significantly, reaching over $380 million compared to about $153 million at the end of 2024. This expansion is largely fueled by their investments. Investments at fair value shot up from around $103 million to over $333 million. That is a massive leap, showing they are actively putting money to work. These investments are primarily first lien loans, meaning they are the first in line to get paid back if a company runs into trouble. This is generally a safer bet in the lending world. Let us peek at some of these investments. For example, they have a first lien loan with FleetPride Inc., with an acquisition date in January 2025 and a fair value of over $4 million. Then there is Aerotech Global Holdings LLC with a first lien loan valued at almost $11 million. These are just a couple of examples showing the kind of companies Crestline is backing. When we look at their income statement for the 9 months ending the 30th of September 2025, we see total investment income soaring to over $17 million. This is a huge jump from the less than $250,000 they had in the comparable period of 2024, when they were just starting out as a private fund. This growth in income directly reflects their increased investment activity. Their net investment income, which is what is left after expenses, came in at a healthy $15.7 million for the 9 months of 2025. This shows they are effectively managing their costs relative to the income they are generating from their loans. Of course, running a lending business comes with expenses. We see management fees totaling around $270,000 incentive fees on net investment income, at $272,000 in incentive fees on net capital gains at $120,000, all for the 9-month period. These are fees paid to their advisors for managing the funds and generating returns. Now for the really juicy part, the schedule of investments. This table lists out all their holdings. As of the 30th of September 2025, their total investments were valued at over $333 million. A significant portion, nearly $300 million, is in first lien debt. In the automobiles and components sector, they have a loan to FleetPride Inc., with a principal amount of over $4 million. Under capital goods, they have multiple investments like Aerotech Global Holdings LLC, and by Light Professional It Services LLC with substantial loan amounts. The commercial and professional services sector also shows a robust portfolio with companies like A&J Holdco LLC and Best Practice Associates LLC holding significant debt. What is interesting is how diversified their investments are across industries from healthcare equipment and services to software and services, showing a broad approach to where they deploy capital. They are also keeping an eye on risks with their fair value hierarchy disclosures. As of the 30th of September 2025, the majority of their investments, over $219 million, are classified as level 3, meaning their fair value is based on significant unobservable inputs. This is common for private debt investments where there isn't a readily available market price. Within level 3, first lien debt investments alone are valued at over $205 million. Crestline also has a credit facility, the SPV credit facility with Deutsche Bank, that committed $150 million for additional liquidity. This is essentially a line of credit to help them fund their investments and operations. As of the 30th of September 2025, they had not drawn any funds from this facility, meaning they still had the full $150 million available. Looking at their commitments as of the 30th of September 2025, they have about $60.6 million in commitments to fund future investments. This means they have agreed to lend this money out, but have not yet done so. This is important for understanding their future liquidity needs. Now let us talk about the risks. The filing clearly states that valuing their investments, especially those without readily available market prices, requires judgment, and that actual liquidation values could differ materially. This is a key risk for any investment firm, especially one dealing with private debt. Interest rate risk is another big one, since most of their debt investments have floating interest rates, meaning the rate can change with market conditions, their income can fluctuate, while 84% of these floating rate investments have interest rate floors which act like a minimum interest rate. They could still be impacted by significant rate changes. For instance, a 300 basis point increase in interest rates could increase their interest income by about $8.9 million. Scroll no for my take on Crestline Lending Solutions LLC. They are clearly in a growth phase evidenced by the massive increase in their investment portfolio and total assets. Their strategy of focusing on senior secured debt in the middle market aims for a balance of income generation and risk management. The increase in investment income is a positive sign that their strategy is working. However, the heavy reliance on level 3 valuations means that their reported asset values are based on estimates and could be subject to significant change if market conditions shift, or if the underlying assumptions in their valuations prove incorrect. Their access to liquidity through their SPV credit facility is a strong point, particularly when they have not yet drawn on it, but their significant unfunded commitments do require careful management of their capital resources. The company is still relatively new, having only elected to be regulated as a BDC on the 2nd of September 2025, and this means historical performance data is limited. Their reliance on the advisor for valuations and management is a critical factor to watch, especially given the upcoming acquisition of the advisor by Rhythm Capital Corporation, despite assurances that services will remain unchanged. This transition could introduce unforeseen changes. Overall, Crestline is showing strong growth in a competitive market, but investors should keep a close eye on valuation methodologies and the impact of the upcoming change in their advisory firm ownership. Alright, that is our deep dive into Crestline Lending Solutions LLC's report. What are your thoughts on their growth strategy and the risks they are managing? Let me know in the comments below if you found this analysis helpful. Please give it a like and share it with anyone who loves understanding the hidden stories in financial documents. And you know the drill, subscribe for more corporate breakdowns and join our Discord community linked in the description for real-time discussions. Thanks for watching, and I will see you in the next one.